Are you worried that we're headed for a repeat of 2008? Well, we have 5 graphs that are showing you that this time is not like the last time. Plus, Jen's back with another inflammatory article. Another inflammatory headline. Let's cut to the chase. Welcome to Cut to the Chase with Jen and Dan. My name is Dan Ferullo, and my co-host, who is in a whole other town, is Jennifer Freed. And we are here back on Zoom, which seems to be now what is going to be the new normal for our podcast for the foreseeable future.
I'm loving it. Today I'm set up in my virtual coffee house. We had snow this morning, so put a little fire in the fireplace for the coffee.
Oh,
and
that sounds nice, actually.
Yeah, I took like kind of a field trip. So yesterday it was all work at my desk, head down, really focused. I was able to get a lot of good work today, tons of time on the phone, but I felt like I was in a coffee shop instead of in my home office. So
well, that's good.
we're taking a home tour inside my home. It's great.
Awesome.
How's things been for you?
You know, things have been pretty steady. I feel like I'm more busy right now because we're trying to adapt to all these different things that we've been doing. So I just had my first virtual listing presentation, which was really quite fun to do because I was able to actually use my computer and kind of show the potential sellers some things that typically I don't like to show them because I don't want to like draw their attention away. So it was kind of fun to do that, but I was definitely rusty. So I need a little bit of practice at it because it was the first one that I've been doing, or the first one that I've done.
Yeah, I'm really excited. There are several realtors around the area that typically set up home tours, as you know, where realtors can see, let's say, 10 homes in 1 or 2 towns.
Oh,
so
sure.
That way our buyers, we can really tell them exactly what's inside the house if it's a really good match for them, for example. And then the sellers of those homes get feedback from all of the realtors who have walked through the homes. So obviously we're not doing those right now because everybody's distancing. But this agent has arranged to do a Zoom call where we're going to share the videos that we have and any virtual tours that we've created for these properties with one another, and still do the tours for these towns, just a totally different way, which I actually hadn't thought of. Like, I've done that one-on-one with clients, but not in a large group. And I think that's fantastic. And I think that might actually be something, that sticks with it because, we don't have to take a spot in the middle of the day. We actually might be able to take
those take so long to do.
Yeah, an early morning time spot, have more realtors participate, everybody gets more out of it. So I wonder if this is a trend that's going to continue. So I'm excited to participate in that.
Okay, cool. That sounds fun. I think there's lots of different things with technology that we've always, or not always, but we've had the capacity to use, but we just haven't really implemented it. And now that we're being forced to, I think this might in some instances make our jobs a little bit easier going forward. So, and because maybe if some things work well, it sounds like we've been adapting and adjusting and just taking things as they come, one blow to one side, then another blow to another side, and we just take it and figure out what to do. So, so in talking about blows, as far as the real estate market is going, we are the economy is headed into a recession, and we are talking a little bit about, I'm going to share some graphs with you guys about why this recession that we're going into is not at all like the 2008 recession. So without further ado, let me share my screen. And there, let me just move.
Oh, look, we're small.
Let me just move you out of the way. Okay. So this is a Keeping Current Matters article, and Jen and I watched a webinar live from Tom Ferry and Steve Harney, who Steve Harney runs Keeping Current Matters, talking about basically what's going to happen or what they're predicting is going to happen in the real estate market in the next few months. And while, of course, nobody knows how long any of this stuff is going to last, there are some things that it seems like they're able to tell you I mean, things may happen that are not good, but why things are not going to happen at least the same way as 2008, because the housing market has not caused this this financial crisis. So number one, mortgage standards are nothing like they were back then. So in 2008, it was super easy to get a mortgage. Basically, they were giving anybody a mortgage, whether you had low credit, if you just had the money to pay, all these different things that they were giving people mortgages for. And now it's really tough to qualify. They are a little bit more strict about what they require as far as ability to get mortgage. And so as far as this graph right here looks, the higher the index, the easier it is to get a mortgage. So during the housing bubble, it was way up here. Now today, it's down here around a little under 200, which is clearly not anywhere near the excuse me, sorry for mumbling, anywhere near how they were in 2008.
So the protections that they put in actually are providing an environment where we now have a situation where we can continue to thrive when other sectors are looking less good. Because on paper, if you still qualify, you're going to be fine moving forward. Everything's explained. Everything is above board. All of the rates are, let's just say, everything's being done in a legal way, a fair and equitable way. So all of the things you remember from last time, none of that is at play here.
Right, exactly. So number two, Jen, you want to take this one?
Yeah, so for home price appreciation, this is a little sometimes hard to wrap one's mind around. So the reason housing prices here, especially on the seacoast, have been so high is because year-to-year appreciation has been way higher than the national or typical average for quite a while. And we're very used to that in this area. These charts are actually showing national averages, but if you look at the years leading up to the housing crisis in 2008, everywhere in the United States, houses were appreciating at 7, 8, 9, 10 times what typical appreciation would be. So there was a huge inflation of what our typical numbers would be. So you have a bunch of folks with loans built on nothing. And the banks can't really secure those because a lot of the buyers aren't vetted properly. And then the price appreciation, those prices are well inflated because the appreciation is so much higher than it should be. So now we don't have that situation. While our appreciation on the seacoast is high because of desirability, the last 6 years, we're nowhere near the way we were in 2008. So it's apples and oranges. Even with our seacoast high appreciation numbers, which is causing a lot of folks to say like, oh my gosh, I can't find a house I can afford around here. That's the appreciation, keeping those prices high. They're still nowhere near those 2008 numbers. So the fact that appreciation has been much more moderate compared to that time is going to keep us from a repeat of 08.
Yeah, exactly. Thanks. And looks like normal appreciation is 3.6%. So we're definitely higher than norm, but definitely not crazy like we were in 2008, near 2008. So number three, we do not have a surplus of homes on the market. We actually have a shortage. So as anybody who's been in the real estate market knows, we do not have enough inventory. So in 2007, there was 8.2 months of available inventory. So basically what that means is that if we were in a vacuum and there were no new homes coming on the market, it would take 8.2 months for all of those homes to sell. So today we have about 3.1 months of inventory. So because during that time there was a and a normal, I'm sorry, and a normal real estate market is about 6 months. So right now we're in a seller's market, then they were in more of a buyer's market, and causes prices to depreciate. So because there was such a high level of homes on the market, the prices depreciated at such a rapid pace because of the mortgage. I mean, because of because of all of that going on with the mortgage, with the ease of getting mortgages. Sorry, figuring out what I wanted to say. Because the ease of getting the mortgages, and then having this happen as well, it kind of like all built up in to create one perfect storm, I guess you could say.
Yeah, also for our area specifically, there are many months we recently are not even seeing a 3.1 month supply of homes
Right.
on the market.
Yeah.
So while that is a frustration for buyers, that is an insulator for this, our immediate marketplace. So that's something that can help you feel good about where we're going to land in all this in our region.
Yeah. And then number 4, houses became too expensive to buy. Jennifer, you want to grab this one?
Yeah, so there's a bit of a ratio, you know, if the wage you're earning and the rate you get on your mortgage, you know, kind of how they work out the percentage of the income you're spending, there was a much greater percentage of what you were making you were spending on housing in 2006. The lending rates were not as good as they are right now, and people's wages were not as good as they are right now for many reasons. That's a different show. Actually, that's an economic show. Yeah, send us a message. We'll send you to one. It's fascinating stuff. I'm a total nerd. I love it. Today, we have a much different situation. While it might not seem this way, wages are actually at, you know, historic highs in this country. Especially New Hampshire, unemployment is at an all-time low. I know right now we are in an unusual spot with where unemployment is, so we're going to have to see a little bit how that number shapes out. But what this is sharing with us is these low lending rates, the 3% that we've been seeing, even lower than that on occasion when we've gotten lucky here. Being able to borrow at such a low rate and make a nice size salary allows you to really take advantage of a quality marketplace. And that was just not present in 2006 the way it is today. And this really shows you, you know, how that median income needed to be able to buy a medium priced home, how that is different between then and now. It's pretty drastic. So yeah. That's another important thing. And I know it doesn't feel that way. It doesn't feel like we're making all this money. It doesn't feel like lending rates are that great, even though we're hearing about it because we've gotten really used to lending rates being excellent. But, you know, not so long ago, I borrowed in 2005. I remember those rates.
All right, great. And then this one I really like. People are equity rich, not tapped out. So homeowners at the time leading up to the housing bubble were using their homes as almost ATM machines. They were, as soon as the equity built up, they were taking cash out. So a lot of them were underwater on their mortgages when the prices decreased. So in 2005, 6, and 7, there was $824 billion in home equity that was cashed out by refinance. Right now, 2017, 18, 19, there's only $232 billion. So homeowners are being much more responsible with their equity in their homes and are using, if they're refinancing, they're maybe just refinancing to get a lower rate. They're not taking all their money out. So they're not in such a strapped position. I mean, we're at a $500 billion difference from where we were 12 years ago in 2000.
Yeah, the other thing that I think is important in this chart is that the change in the lending laws really made it so buyers do have to have some skin in the game. There are fewer programs that are 0% down. So folks are starting with some money in the home. because back in that time period, you could sign on for a $500,000 home with an adjustable rate mortgage and put nothing down, which means if the market had a shift even of, you know, a certain percentage in your lending rate, plus let's say, you know, the market dipped somewhat just for usual, you know, natural market changes and the value of your home changed, you know, instantly you're in trouble.
Mm-hmm.
Like there's absolutely no room there. So I think lenders actually are protecting you already from that somewhat, and that is being shown in this chart.
Yeah. And then there's one last graph I just want to show to you.
Oh, bonus. I love a bonus, Dan.
So this is probably one of my favorite graphs. So this shows what happened in the last 5 recessions to home prices. So in 1980, 1981, what's it doing this again? Open. Here we go. 1980 and 81, home prices increased by 6.1 and 3.5% respectively. In 2001, home prices increased by 6.6%. So these are 3 recessions that we've had that home prices actually increased because there was a lack of supply. I mean, and there was a higher demand. So, and that almost seems like that seems like where we've been for the past couple of years. We have a lack of supply and a huge demand. In 2008, because the housing crisis caused the recession, home prices dropped almost 20%. And then in 1991, home prices dropped by about almost 2%. So a very minuscule amount that the home prices decreased. So seems like, looking at this data from the past, when we go into a recession, instead of actually home prices going down, which you might think, it's likely that they may actually go up. So I think we'll, of course, wait to see what happens because we are not sure yet, obviously. However, looking at the data from the past, I think that home prices at least seem to be headed in an upwards direction.
Well, that, and I think if we think Seacoast and Southern Maine specifically, our appreciation has been healthier than the national average. So we have a little bit more wiggle room to come to typical appreciation. So we can come down from above average appreciation to typical appreciation. So our bar might not hit the red point, you know, if we look like 1991, for example.
Yep, exactly.
So that's a perk of living in an area of the country. Many industries, retirees want to live here, university jobs, you know, has a lot of diversity going for it in terms of people that need to find housing. So there's a little insulation there. Plus, you know, ocean is ocean. So
yeah,
people come here for that as well. And, you know, you can't build New England charm anywhere else. I think most people, a lot of folks are talking about, you know, the last big thing that happened in this country, and that was 9/11 for many folks. Not for everyone. There's been some other, you know, big events that have happened, but for many it was 9/11, and there was a point where people wondered, well, gosh, what happens next? And there is a point when we get back to life. And so we will get back to life, and people are gonna, you know, want to retire, and they're gonna want to find that cute little town up here, you know, with our coffee shop that I'm recreating in my living room, and all of that. So time for my little article. I'm not going to put it up on the screen. I'm just going to take a quick peek. This one is Forbes. It came out on Friday. I'll put a link to it. So that the headline caught my eye right away. Just how bad is it? Here's the economic damage the coronavirus will cause, according to major banks. So this is a Forbes staff writer, and of course I looked, before I even read it, I looked about, I'm like, all right, who's this guy? Is this an opinion piece? You know, is this guy, you know, what has he done? So he's New York based. He's focuses on financial topics. He also wrote for Money Magazine and interned at Forbes. Went to St. Andrews, International Relations, Modern History. All right, so this is no slouch. So the points that this article makes. So it starts with a bunch of economists that it quotes. I like this. I like when it says, who's economists? What are they saying? So we have a bunch of doom and gloom key points. You know, economists on Friday, 24% hit to the second quarter GDP. Then B of A late on Thursday, recession due to the coronavirus pandemic, jobs we lost, wealth destroyed, confidence depressed. Let's see, then Morgan Stanley, right? So we're Whammo, Goldman Sachs, B of A, Morgan Stanley, Deutsche Bank, UBS, right? So wham, wham, wham. I feel like I got punched left, right? Then, but most of the economists at the big banks listed above still predict the economy will rebound later in 2020 or by 2021 at the latest. Well, and that just goes right back to your slides. So I went from this might be bad, this might be ugly, wow, I better like keep reading, to all right, can you people chill with your headlines? You're making me crazy. So you know, it was effective. It got my attention, made me worried and everything.
At least you read it to see that they're saying that there's some light at the end of the tunnel, rather than just looking at those headlines and saying, oh darn, we are screwed.
But isn't that human psychology? How many more people read that because it's like doom and gloom I can't say it, doom and gloom economy versus we might be at the end of 2020 into 2021. That's a headline that would make me smile, and I'd say like, all right. And that, you know, kind of points to my comment segueing in, which was like, there is a point, no matter where things go, certainly everyone's concerned, that life is gonna pick right up. You know, everyone's gonna wanna get their life back somehow. So anyway,
well, looking forward here to getting our lives back. I know we still have a long ways to go. We're probably not nearly out of the woods yet. And things are probably going to get worse here before they get better. However, it is uplifting and nice to see that the people who help us to do our jobs, to help you as our clients and friends, help us to help you to stay informed, are telling us that yeah, things are going to get bad, but then they're going to get better. So that's kind of where, you know, my mindset and my head is, and when we're all by ourselves here at our house with me with my little orange friend, and yeah, so I think I'm glad we're going to make some changes and things are going to hopefully work out eventually in a positive way.
Yeah, and if Dan and I can do anything for you guys, or if you even want just some dumb, stupid fun, shoot us your ideas. We'll do a dumb, stupid fun show. I'm always game for that. You know, who knows? Throw us a good idea and we'll zoom it up for you.
Oh, zoom it up. I like that.
Is that a verb now? Can we zoom?
I think Zoom is probably going to be like the next Google, like, oh, hey, you want to do a Zoom? And maybe buy some Zoom stock, because it's probably the only one that's gone up in the past few weeks. All right. So thank you so much for tuning in today to Cut to the Chase. Please like our videos, subscribe to our channel.
Follow us everywhere.
What are you guys thinking? Yeah, what are you guys thinking? Let's all try to stay positive together and we'll get through this.
All right. Bye, guys.
All right, bye.